What is going on with the economy today? We've seen markets are down, including the cryptocurrency market, where $1 billion in assets held in cryptocurrencies have been liquidated. So, a lot of people have different reasons for what's going on, and that's because an economic system is composed of many different human decision makers. Not everyone sells their share of stock for the same reason. But when many people do it at once, there's a few things we can point to. That being said, they're not every single reason that's out there. The one that you might be hearing the most is the recent jobs report in July. 114,000 jobs were added in July, which might sound like a normal number, but in the context of what's been happening with interest rates over the last 2 years, this actually does mean something, and it could have triggered a large part of this instability, this downturn in the market. So, Jerome Powell, the chairman of the Federal Reserve, said at the beginning of the pandemic, when prices were high, a big reason for that was supply chain constraints, but he pointed to the labor market and said inflation's being caused because the labor market is hot.
In the middle of this is a labor market in the United States where people can get paid well. It's too hot.
This was at a time when many economists agreed from all over the political spectrum that current inflation was a supply side problem. When there's a pandemic, you have input costs go up for various reasons. There can be worker shortages, supply shortages from somewhere else on the supply chain, and you could have projected revenue losses. And all of these reasons are why a company might raise their prices.
It's a very, very good labor market for workers. And it's our job to get it into a better place.
And so his solution was raising interest rates. The logic behind this is that if you raise interest rates, this makes it more expensive for people to take out a loan and invest in a business or start a new one, because now you're paying more interest back on that loan. And so there will be less economic growth if there's less investment. And that means there will be less jobs. So workers will be competing for jobs. This allows employers to offer lower wages and benefits, and workers will still take the job because they'll get desperate. Workers will also be less likely to ask for more because they know that they can just hire someone else. So workers are taking jobs for less wages and benefits than they would want. Now, during the pandemic, there was this movement of essential workers and workers demanding hazard pay and additional benefits because the whole world saw that workers were essential. And we saw what happened to the supply chain when workers can't show up. This meant that there was a new fire in the labor movement, and I guess that made the labor market too hot in Jerome Powell's eyes, and so they intentionally tried to create unemployment, because their theory is that if less people have jobs, less people have money, they're not spending it into the economy and making demand go up, which makes prices go up. So if less working people have money, we're going to solve the inflation problem, which is not how it worked at all. We saw corporate profits towards the end of 2020 at $2.5 trillion. At the end of 2023, for the year, we saw corporate profits at $3.4 trillion. They increased by $1 trillion. This is ridiculous. Also, what we saw during the pandemic is wages not being a part of price increases. So corporations at the beginning of the pandemic did have additional input costs. There was all of these supply chain issues and a lot of instability. And so what many companies did to account for this is raise their prices, but they kept them high unnecessarily. And I think there's a few reasons for why they made that decision, and I actually think the Fed raising rates is one of them. I'll get to that in a second. But for now, what's important is that we know they decided to raise these interest rates to stop inflation, when in reality, if you look at these balance sheets, you're seeing companies raise prices and 53% of the money made off of them going directly to corporate profits. We also saw workers' wages before the pandemic for many, many years, accounting for over 60% of price increases. So a very small portion of this money during the pandemic is going to workers. I also think it's important to show that the Federal Reserve admitted that raising interest rates didn't really resolve inflation.
As unemployment goes way down, more jobs, there's pressure on wages and salaries and so forth. Is there a new paradigm out there as far as evaluating this today, and is it because of the global economy, or what is it? Because we have low unemployment, but we have, at the moment, not a lot of pressure from your testimony and what we observe on inflation.
So the relationship between slack in the economy, or unemployment, and inflation was a strong one 50 years ago. If you remember that in the 60s, there was a close correlation there, and that has gone away, and it's really been
But we had a different economy then, did we not?
Very different economy in so many ways. And in this way, that really, I would say that period, at least 20 years ago, that period was over, and the relationship between unemployment and inflation became weak. It's become weaker and weaker and weaker.
That was 2 years before the pandemic. This was during the pandemic on the floor of Congress.
According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an
just a math
intended
problem.
consequence. It's
Well,
not,
but it is, and it's in your report, and that would be about 2 million people who would lose their jobs, people who are working right now, making their mortgages.
And so here we are. The July jobs report shows that job growth is slowing. So the Federal Reserve has achieved their policy goal with this series of interest rate hikes that started during the pandemic. And now many Wall Street investors pay attention to this stuff, and they're anticipating a rate hike in response to the slowed job growth to sort of get things going again. So we see people selling their shares and liquidating their cryptocurrency. Because of this anticipation, they're not expecting a good investing economy to come of this. And there's a reason for that. If interest rates are high, who benefits? Banks benefit because they sell loans, they sell debt. When people have to pay more interest on their loans, on the debt that they have to the banks make more money. So a high interest rate environment means banks are raking in the dollars. And what do banks do with their dollars? They invest them. And so I think a lot of people are anticipating that there's going to be less investment than we've seen in recent months as a result of interest rates going back down. And I think that is why we're seeing people making the position that they have in the stock market. Also, we've seen a lot of people raise questions around what high interest rates have done to the economy as a whole, not just for Wall Street, which, while the market has impacts on the economy, the real economy is something different. The real economy involves all of our productive capacity, workers, land, resources, materials. And the real economy and our productive capacity has not been impacted. We're not in a time of economic downturn. We're just seeing instability in the stock market and that the stock market's down. However, we do have a lot of concerns about economic growth relative to interest rate hikes. So when interest rates are high, small and medium-sized businesses likely will not invest because it's so much more expensive. Big corporations can usually afford rate hikes while they're less likely, to take out loans and to invest in a high interest rate environment. They still do. They can afford it much more than small and medium-sized businesses. So that's really important to know. It's also created this avenue in housing for people, usually large investment firms, not actual people or families. They can afford to buy houses in cash. A lot of people are not taking out mortgages and purchasing houses. We've seen in some markets in the US where investors are purchasing 30% of the homes, and that's a huge transfer of assets to the investor class. So there's a lot of ramifications of this. It hurts workers. We've also seen this really impact the economy as a whole in an interesting way that I haven't seen a lot of people talking about, but I believe it to be true. So, because you're not having this influx of capital and you need money to make money, you need to buy land, machinery, tools, pay workers in order to be productive, to invest in your business, start a new one, to grow your business, and therefore grow the economy. Because that capital is less likely to come in because interest rates are so high, a lot of companies, instead of investing, are simply raising prices. Partially because Wall Street and shareholders expect consistent growth. So there's this pressure to show increasing revenue, increasing profits, and while they don't make their products any better or more valuable to consumers, society at large, or the economy, they are increasing prices so that their balance sheet reflects that on their quarterly reports. That's not so good for workers or consumers or businesses who should actually care about creating a good competitive product. There is less competition when big businesses are doing quite fine and we see smaller and medium-sized businesses struggling. That is concerning, and that is a result of high interest rates. It could mean inflation's a little bit more sticky or prices stay higher for longer because these businesses are not improving their products, but they want to increase their profits, and so they're raising prices instead. Now, of course, we live in a global economy, and a lot of people are talking about what's happening in Japan. Now, Japan has had low interest rates for a very long time. So, in an environment where the United States has high interest rates, a lot of investors, and I've talked to people who do this, guys who have run hedge funds and investment firms, they will look at what the expenses are to get a bunch of money in, say, Japanese yen in this case, and at a very low rate, take out a loan, and then use that money to invest in higher yield currencies like the euro or like the dollar. Warren Mosler, who I interviewed on the Funny Money podcast, spoke about leveraging against the lira. When the lira in Italy was struggling, he said, well, they're selling bonds, they're selling treasury bonds. We make a pretty decent interest rate, and then we can use that money. So we're going to tell everyone at our hedge fund actually to purchase this. And this was at a time when a lot of people didn't believe in the Italian currency. But like any fiat currency, the government can issue more notes. They have never not made good on an obligation. So it's a pretty secure investment. And so what's going on with Japan has happened many times over. But what we're seeing now is as a result of this trade, it's kind of unwinding because this meant the yen was pushed down. And so many people wanted those Japanese products for less. Japan saw their export sales go up, and then the local stock market looked pretty good. And Japan is now raising their interest rates. And so when people were getting capital from Japan, they're no longer confident in Japan as a source for their loans. I don't think that accounts for everything we're seeing in the economy today. I think another factor is people look at folks like Warren Buffett, who's changed the positions of Berkshire Hathaway. He sold a lot of stock that people didn't quite understand or weren't expecting him to. And I think a lot of people look at these billionaires, especially ones like Warren Buffett, as people they should follow and mirror the trades of. But Warren Buffett is someone who's looking in the extreme long term. And I think he's actually the type of guy to look at what's happening at the global level and see hostilities on the rise among global powers. We've seen a lot of recent news suggesting that's the case. We've seen the United States send additional ships to the Middle East. It's really concerning. That is a signal perhaps to someone like Warren Buffett who's thinking about the long term that there will be instability in the future, and he could be hedging against that. The other fun part of this I want to talk about is cryptocurrency. Donald Trump spoke recently at a crypto conference and said, have fun playing with your Bitcoin and whatever, as if he didn't take Bitcoin and crypto seriously. It was a really funny clip to someone like me.
Thank you all. Have a good time with your Bitcoin and your crypto and everything else that you're playing with.
I don't think that went over well because the crypto community kind of likes Donald Trump, and he, I guess, went back on his position that crypto is something you play with like a toy, and he said we could pay off the national debt with Bitcoin. So I don't think people are selling their cryptocurrencies in anticipation of that happening, but I would like to believe there's a world where that is what's going on. Because what would happen if Trump actually was president and pursued this in a magical world where Bitcoin can handle a $36 trillion transaction? He would have to convince Congress to issue the dollars to purchase Bitcoin. So 36 trillion from Congress. They have the power of the purse. They can appropriate the funds with the votes. Then it would have to be credited to an account where Trump takes it and purchases Bitcoin. What would happen to Bitcoin? Of course, that's a huge injection of cash. And Bitcoin is not really an alternate currency. It's not a different kind of money in the sense that the dollar is money. Bitcoin gets all of its value from people investing fiat money into it. That's like euros, yen, dollars, government-backed currencies. If you could not make more dollars off of putting money into crypto, people wouldn't put money into crypto. There are a few people who use it for various things on the internet where they want anonymous transactions, so it does have a purpose in that sense. But many people are investing in crypto with the hopes of exchanging it again for US dollars. So when we see many people liquidate their crypto assets, is it because they're anticipating Donald Trump purchasing a bunch of Bitcoin and then reselling it? Because that's what he would have to do. He would not only have to purchase 36 trillion in Bitcoin, he can't pay off the debt in Bitcoin. He can't pay interest on treasury bonds in cryptocurrency. He's going to have to then sell it again and take those dollars and pay off the debt. That's how it would have to work. So that's not so good for crypto to invest 36 trillion into it and then pull it back out. At that point, you might be thinking, why doesn't he just print the dollars to pay off the debt? Why doesn't he just issue the currency to do it? That is a great question. I don't think he understands cryptocurrency or the monetary system in the United States, and that's why I said that. But what's going on in crypto right now, I think, is just, it's an investment market. We're seeing instability in investments altogether. A lot of banks, believe it or not, have some of their assets in cryptocurrency, which is concerning, maybe, but it's true. And so I think a lot of what we're seeing is people acting on their anticipation that we're going to see interest rates go back down and banks investing less, and that this will not be so good for the stock market. There could be some other things happening. There are many things happening all at once. The economy is not a homogenous place where everyone wakes up and makes the same decision for the same reason. But that is my sense of what has caused today's downturn in the stock market and the crypto market.